Good evening, everyone. Today I will be discussing the current trends in individual lending, how it has evolved in recent years, and what the future looks like for retail credit in India. So, moving on, we can see the introduction. So, it says the individual lending, also known as retail lending, refers to loans given to individual for personal consumption or asset creation. Unlike corporate lending, these loans are smaller in size but larger in number. Over the last decades, retail lending has become a core revenue driver for banks because it offers better diversification and sustainable returns. So, why it matters? Retail loans typically yield higher interest margin than corporate lending, diversifying uh, credit exposure across many customers, and it reducing concentration risks and support customer lifecycle engagement, opening cross-selling opportunities for deposit, cards, and wealth production. So, moving on to the next slide, the growth of retail lending in India. Retail lending growth in India has outpaced corporate lending in last few years. Banks are focusing more on individual loans because they are less risky compared to large corporate exposure. Rising disposable income and aspirational spending have significantly boosted demand for home loans, vehicle loans, and personal loans. So, as we can see, there are two major segments, that is major bank expanding and market opportunities. So, in bank expanding, we can see that SBI, HDFC Bank, ICICI Bank continues to increase retail book share through distribution, tech investment, and product innovation. Large and in market opportunities, we can see that large unscaped pocket in tier 2 and tier 3 cities are running sustainable and giving sustained growth potential over the next decade. So moving on to the next slide, that is our digital transformation in lending. So we can see that it is one of the biggest trend in individual lending in digital transformation. Either loan approval took several days with heavy paperwork. Today, with eKYC and AI-driven credit scoring, loans can be approved within some minutes. Fintech companies partnering with banks to provide seamless digital experience. This has expanded credit access even to first-time borrower and gig workers. So we can see the traditional model and digital model. In traditional model, we can see that manual verification in branches, long turnaround times, and higher operating cost per loans. Whereas in digital model, we can see that eKYC, e-signature, and mobile onboarding, which took very less times compared to the traditional model. And in digital model, we can also see that AI and ML credit scoring are automation and low cost faster scale, whereas compared to traditional model it is high operating cost per loans. Moving on to the next slide, that is rise of BNPL and instant credit. So buy now pay later is a current trend is going on throughout the world, and instant checkout credit have become mainstream for small ticket purchases. BNPL provides short-term, often zero-cost EMI options and drives conversion at e-commerce checkouts. And for we can see that checkout financing platforms such as Amazon Pay, Flipkart integrated BNPL to improve basket size and conversions. Instant credit, that is embedded credit APIs and instant underwriting, enable near-time, real-time approval at point of scale. Moving on to the next slide, that is use of data and AI in credit assessment. So, bank increasing adoption alternative data and AI to access retail credit more accurately, because with the help of AI and these fintech tools, they can give more accurate credit scores, and input includes UPI transaction history, GST fillings, bank statement, mobile behavior, and utility payments combined to produce granular credit risk profiles. So it has a faster approvals, reduce NPAs, and improves risk profiling. Next is our interest rate and economic impact. So interest rate and macro cycle directly influence retail demands, and increase in RBI's repo rate typically rises market lending, pushing up EMIs and slowing discretionary borrowing. Conversely, rate cuts and stimulate demand across housing and consumption statements. Retail lending has structural resilience in India due to low penetration relative to GDP and a large underserved rural and semi-urban population, creating a medium-term growth runway even in tighter cycles. To Now, risk management trends. So there are three states: stronger underwriting, early warning signals, and portfolio diversions. In stronger underwriting, we can understand it enhances the scorecards, more income verification, and stress testing. And early warning signals, that is transaction anomalies and payment behavior, trigger proactive collections. Whereas in portfolio diversion, we can see the spread risk across product, geographies, and customer cohorts. Next is emerging trends in individual lending. Key trends shaping the next phase: embedded finance, that can be loans inside platform, hyper personalized credit offer using AIs, that, and then we can see ESG linked retail products, expansion into tier 2 and tier 3 cities, and stricter digital regulation to protect consumers. This shift will require banks to partner with platform, modernize core system, and deploy large targeted credit products tailored by income brand and life stages. Next is the key challenges that is facing. That is rising household debts. Increasing indebtedness increases vulnerability to shock and can rise portfolio stress during downfall. And then we can see the over leveraging via BNPL, fragment credit from multiple BNPL provider can mask true borrower exposure. Then it comes to cybersecurity and data privacy, that we all know that in with AI and all, there is a small um, part where it is becoming a challenge and it needs to be reduced, that is cybersecurity and the data privacy of a customer. Then we come to the regulatory compliance cost. Meeting RBI requirement for fair practices and data transparency raises operating expense and governance need. Moving on to the next slide, we can see the conclusion and strategic priorities. So, which priorities we should focus on more basis? First, that is accelerating digital underwriting and integration with channel partners. Number two, build strong EWS, stress testing, and provisioning framework. And number three, that is design consumer centric, inclusive product for tier 2 and tier 3 cities. Next, we need to align products, risk, and data terms to deliver a phased roadmap for growth and with control. For questions or tailored version, we can follow up with a bank specifically diagnosed session. And in conclusion, we can say that retail lending remains the backbone of bank profitability in India. Digitalization, smarter India, smarter digital data use, and disciplined risk management are the three pillars for sustainable growth. Banks should prioritize investment in AI-driven underwriting, expanded responsibility into underserved markets, and strengthen governance to navigate evolving regulation. That's all from my side. Thank you for watching the video.